Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market. You all know that drill. Smash that like button, subscribe if you already haven't. And I just want to do a video today, just updating on, we talk about the big four bubbles here, the auto loans, the commercial real estate, the housing market, but there's also the auto loans and the credit card debt. So just wanted to go over a little more information. Uh, and those aren't even all of them. There's the Treasury one, but I see that being more of a long term. And the municipality, state and local. And I expect the municipality to really come undone when the housing market collapses because they're going to lose a lot of revenue because there are a lot of property taxes. Revenue is going to decline. And I think that's what, so municipality and those ones come later. But these are the ones, and I think these are the ones that will do the this administration in. Not its fault. Well, I guess you can say it was the first term, but it's all the predecessors, but not this current. But anyway, here it is. This is an article, Yahoo Finance. When was this done? I recently came. It's very recent. Overall, household debt is at a new high. $18 trillion. All right, there it is. Yeah, February 16th. So, and then first it talks about, this used to be a New Year tradition. 3 months of the year were the busiest. Um, but now the trend is disappearing. Not because they got out of their debt, but now they need help throughout the year. And it's because of their pricey car loans and credit card debt. And credit card debt is it's two reasons. One, the high cost of living. Two, most of the jobs in America are low paying. Those are the two culprit reasons. High paying jobs, there's some solutions, but I don't think it will get astronomically high. So in order to have a good life in America, they have to allow asset prices to fall because the asset prices are what causes the inflation. It's not wages, it is asset prices. America in real terms, wages are tanking, but it's asset prices. And US economic policy is based on inflating asset prices, and it's just it's a Ponzi scheme, really. Those born or who got into the workforce later are the ones who, they're going to be screwed. They're the pooch that's getting screwed. So we have to allow housing and stock. This is actually good. The reason I talk about it badly is I think they're going to try and inflate it. If they're going to let it fall and then not try to reinflate it and have more of a production economy, that would be a good thing. So, but here it is, pricey car loans and ballooning card credit debt. And these auto loans are sort of new. During 2020, when they really propped up the auto market, auto prices, a lot of people could sell their cars and get out of debt. And that's why that was sort of put on hold. But now this has resurfaced. So, as it says, the landscape has changed. And this is what I'm talking about. This is Yahoo Finance mainstream. And with Trump in office, this is what I told you guys. You're going to start to see bad economic data next year, and they're going to be more honest because the elites don't like them. So they're going to be, I'm not saying they're fully honest, but they're going to be more honest. So many are stuck in unaffordable car loans, while others have turned to their credit cards over the past year to buffer themselves from higher prices on groceries and gas. And of course, notice how they make the energy efficient cars very expensive. So, uh, they say inflation's not completely under control. What's sort of annoying about this is when they're like, yeah, we just got to get inflation down. All it means is prices are rising at a slower pace. But the thing is, the base is too high. They need actually deflation. They need falling prices. That's what they need, not disinflation. So generally, the market would new high in the fourth quarter. No, this isn't the part. So basically, credit card balances increased by 4%. That's a record, 1.21 trillion. And look at this here, credit card debt. Look at that, quarter four 2023. This is the most recent. And you can tell it's just 2010, 2011. Then it started going up more, and you can tell the stock market in 2011, that's when it really began. It's really moving. Gold started going down, so they were inflating a bubble. And then with all the stimulus, most were able to pay down the debt. But this is when the inflation came, and you can tell credit card debt just gone out. Is this, yeah, astronomically. So normally they used to blame it on seasonality or population growth, but this is what they cannot avoid. The trajectory of serious delinquency rates, especially for auto loans and credit cards. So share of borrowers 90 days or more past due is at a 14-year high. Well, yeah, you have higher cost of living and lower paying jobs than 10 years ago. So what do you expect? People are going to be in a bit worse situation. So auto loan payments are causing a lot of stress on how people pay for living expenses, increasing the reliance on the credit cards. And part of the reason auto loans is, have dealerships, you have factories, everything, and make them when prices of housing and everything are overinflated, that actually gets passed on and creates. So, I mean, some of it comes back to housing. So, so there it is. Auto loan delinquencies specifically been rising across credit scored brands and income levels. So it's even affecting the wealthy. And what also is hurting them is not only do they have these expensive auto loans, but then they have the insurance premium. Last month, vehicle insurance rose 2% and almost 12% from a year ago. So, of course, we have bigger population. So, and yeah, look at this. For a lot of people, decent paying job, cut expenses across all the way, but the car was the biggest expense. Yeah, and if you have a fixed car payment, you can't just cut that. You can't. It's just that's a fixed cost. So this is a bad thing. It's not like dinner. You can eat less food. Or you can substitute, but you can't just with so average payment for used cars 525 and for new cars 734. Wow, my payment's way below that. I am lucky. People are paying 21 to 22% of their incomes towards payments. This is why I said wages aren't high enough. A quarter of people's income are just going to an auto loan payment, and that doesn't even include rent. Rent is super high, and then student loan payments and everything. So this is a bubble that's going to burst. And the reason why I say that is like if you default on student loans, they garnish your wage. Default on rent, you don't have a place to live. Like based on a lot of the auto loans, the collateral is it hurts your credit score, but the collateral is they just take your car. So that's why I always thought this was going to be the first thing to go. Look at this, the terms of these loans are increased to 78 months. Well, they had to, because look at these payments. Imagine if they did 48 to 60 months instead. Yeah, and they're these unimaginable payments for 6 years. And this is why, and this is turning to credit cards. People are turning to credit cards that are 28%, which, I mean, what's the point of a good credit score? My credit score is 800. It's really good. And I looked at my interest rates on my credit cards, so like 29%. Like, what do you have to do to get a good interest rate? I have really good credit. So, I mean, it is absurd what's going on. I completely support capping it to 10%. I'm against usury. They should do everything. Everyone's like, well, how do they loan? Well, certificate collateral and also asset price deflation. Under my system, we'd have stronger currency and you buy more things over time. And then you would have collateral, certificate on deposits. But anyway, that's never going to happen. I'm willing to guarantee you. If it does happen in an economic system, well after I die, but never say never. Credit card interest rates aren't going down anytime soon. So yeah, here's more stuff about the tariffs. They do want to blame, yeah. But yeah, there you go. You can see the auto loans, and this may be the first one. I thought it was commercial real estate, but this auto loan is really a bad thing, and there are a lot of banks highly exposed to autos. I actually saw a really good JP Morgan, Ally Financial, Wells Fargo, Capital One, and Bank of America are major players. Now I refinanced my auto loan, so I actually have a good payment. But and then this is the other one I want to do. Breaking down the auto loan performance. This article is February 13th, 2025. And so let's go. I think this is all graphs. So here's the first thing. These just explain the graphs. Mid-prime and subprime originations volumes uh, are stable. So this is people with really good credit. This is people with, let's see. So yeah, see, it's like the chart below the pick. So you can see that. So, so here it is. Auto loan delinquencies have been rising overall. And if you look at it, here's where a lot of the delinquencies are rising. 2021, this is people below 620. 620 through 679, you can tell significantly higher. As you know, markets are non-linear. So it's come down since September, but this came down, then it went up. That's 680 through 790, but that's increasing. And then even people with good credits rising slowly, but it's still rising. And then the really good credit score is just the same. So, and if you look at it, where is this going? Larger banks, you can see it's going up, but I always like to do pre-pandemic smaller banks. They seem to actually be the least effective, but if you look at it here, it is coming up now. Captive auto financing. Look at auto financing. That's where it really credit unions. So yeah, it looks like the credit unions are sort of the best captive, larger banks, but the really one is the auto financing. So maybe like Toyota Financial. I used to have a loan with them. And lowest income, you look at here, this is the blue. That's gone up, but the second quartile, it's been rising. You can see that. third quartile rising still. And even the highest income, you look at it, even though it's not that much, it's still rising some. So you can tell that, it's what I say, it's trickle up poverty. And so it's going to start with the lowest, but and you can even see the highest earners started at below one on this chart, and it's still rising somewhat. 1.53. It started at 0.87, 1.53. So yeah, you can tell the auto loans, and this is what it says: auto loans, higher car prices combined with higher interest have driven monthly payments and put consumers across the board pressure. So as you can see, the auto loans, it's getting worse and worse, and that is something that will be the undoing of this bull market. Just remember this: bear markets are the authors of bull markets are the authors of bear markets. Stock market I think, could run up, and I even see it going to 6,500 to 7,000. This is going to be a nasty bear market, and I think the days for investing it are probably over. It's probably more of a trading market now, but we'll see what happens. Just remember the disclaimer: nothing I said should be financial advice, just my thoughts and my opinion. I'll see you next video.